T Mine. Today we're pitching Constellation Energy. As of market close yesterday, it was trading about 275. Given our price target of 345, that implies about 26% upside. So who's Constellation Energy? The nation's largest unregulated utility company. They're a merchant power producer, essentially meaning they set competitively price their sales of electricity as opposed to earning a regulated rate of return. We believe that they're a pure play nuclear and gas generation currently, since they spun off from Exelon in 2022. And they deliver about an output of 5% of the U.S.'s electricity demand or generation. And post the acquisition of Calpine, which we'll get into later, they're going to have 55 gigawatts of installed capacity.
And to touch on management and leadership a little bit, CEO Joseph Dominguez has had nothing but success leading this company. He was the architect of the 2022 spinoff from Exelon, and he was also the architect of the $27 billion acquisition of Calpine. He's also been able to successfully commercialize their large nuclear fleet into purchasing power agreements with AI hyperscalers, which we'll touch on later, all while maintaining a clean and healthy balance sheet.
So overall, I want to zoom out a little bit and see where the electricity grid is going from today. Overall, we're seeing a structural supply shortage thanks to incremental demand from AI, which is, we project, and also a consensus estimates project to rise by 91% by 2030, which is an implied CAGR of 14%. Overall, this is materially driving up wholesale electricity prices, which are up 23% year over year. Another metric you kind of use to forecast and see into the structural supply shortage is capacity auction prices, which more recent ones for 2025, 25, 26 clearing prices were up 10 times. And overall, besides just incremental demand build out of AI, we see steady grid investment, which is projected to grow from a generation standpoint at about 2% CAGR. This feeds directly into our thesis point number one, which we believe their nuclear generation base is advantaged right now from a cost perspective. They operate at one metric as levelized cost of electricity, which is about $34 per megawatt hour, which vastly outprices and is a lot more economically feasible than nukes build nuclear, which operates about $180 per megawatt hour and remains competitive with onshore and wind and solar generation assets. Overall, we believe an elevated price environment should expand margins nicely. Downside protection, thanks to Trump's one big beautiful bill. Solar and wind production tax credits were phased out, but nuclear was sustained and retained through 2032. We believe this acts as downside protection. And nobody is best able to capture these nuclear tailwinds better than Constellation, given that they have the largest nuclear fleet and operate about 23% of the nuclear fleet in the United States.
And playing into the AI structural tailwinds, they've been able to successfully commercialize their nuclear energy. AI hyperscalers like Meta and Microsoft need 24/7 carbon-free energy, which intermittent power sources like wind and solar cannot provide. On their best day, they can run 8 hours, and that's only if the wind is blowing and the sun is shining. And they still can't power facilities like these. Nuclear checks all three boxes. It's always on, zero emissions, and it's available at scale. And due to the scarcity of the at-scale zero-emission energy, they're able to command premium prices, as demonstrated by the two landmark PPA deals with Microsoft and Meta, which contract them over the next 20 years to $115 per megawatt hour, which is roughly 2 times the prevailing market rate. And we expect CEG to be able to continue capturing these purchasing power agreements at above market rates and generate stable and durable cash flows in the future.
Our third investment thesis is the Calpine acquisition, which closed in January of this year with a deal value of $26.6 billion. It's primarily an equity transaction. The main thing we love about the acquisition is the diversification, not only geographically as it transforms Constellation from just an East Coast provider to a Coast to Coast provider, but also in the way that they produce the electricity. Before the acquisition, they were just the largest nuclear fleet in the U.S. After the acquisition, they additionally have the largest natural gas and the largest geothermal. This acts as a natural hedge. Prior to the acquisition, when natural gas prices would fall, this would just be a hit to the nuclear business. However, now that they also have the natural gas generation, they can capture both sides of the commodity cycle. And it's immediately accretive, as management expects greater than 20% EPS in 2026 and more than $2 billion in free cash flow annually before growth. Then we get into some financial analysis with 4 key points as we see as juice for growth. Number 1 is the healthy balance sheet, which is a 0.34 net debt to equity, which is just a fifth of the overall industry. Number 2 is the margin expansion. Due to acquisition costs, hedge losses, and higher fuel costs, they had lower margins over the past year. However, as synergies move in from the acquisition and this contracted revenues begin to build, we see their margins catching back up to the industry average. We mapped out greater than 4x free cash flow growth from 2025 to 2032, which represents roughly a 24% CAGR, which allows them to grow their buybacks and their dividends. Management already announced a $5 billion buyback, and they're growing dividends 10% per year. And for a quick peer comparison, you can see Constellation's financial metrics compared to their peer average, and then in the middle you can see the companies that we used as their peers. So the liquidity metrics are healthy with the current ratio and quick ratio above 1 and outpacing the peer average. Again, we can see the operating and net profit margins are below. However, for the reasons that I mentioned, we see them catching back up to the peer averages. Return on equity is healthy, and the return on invested capital is the highest among all their competitors. Again, we see the debt to equity, net debt to equity, which shows the healthy balance sheet. And then they can pay off their interest more easily with an 11 times EBITDA to interest ratio. And I just want to quickly mention for reference, there is no other company in the United States like Constellation, as you can see with the total nuclear capacity. However, these are the companies that we thought were most close to them.
And for the valuation, we used the free cash flow to the firm model, discounting Constellation Energy over a 7-year period using a WACC of 8.34%. This arrives us to an enterprise value of $124 billion. And one thing I want to specifically talk about with CEG is the NDT fund surplus fund, and that's the surplus from their asset retirement obligations. So companies with nuclear assets, they have to dedicate money to asset retirement funds, and the surplus is actually accreditable to shareholders. So that brings us to an equity value of $125 billion with an implied share price of $345.22. And we did use a terminal growth rate of 3% here to match the structural electricity demand in the U.S. over the until 2030 and beyond, as well from data centers and the electrification of America, as well as the PTC floor that gives them a 2% inflation adjustment per year. And we also did some sensitivity. We also did some sensitivity analysis. We identified a bear case of $302. We identified this as long as AI hyperscaling slows and the build-out does not progress as planned. The base case under what we just discussed previously, and we did identify a bull case when Calpine and the integration becomes fully synergized. We think that they can have more stable and less volatile cash flows and artificially reduce their WACC through beta compression.
And overall, every thesis comes with some risks. Overall, 22 times EV/EBITDA and 35 times PE, CEG's price for growth. As mentioned in our bear case overall, we assume that CapEx will continue. Demand risk if electricity demand doesn't materialize, that directly affects top line assumptions. Regulatory and political risk from administration to administration. Agendas can change, and the production tax credits may not last forever. And Calpine integration risk, given its size and assuming about $13 billion debt, integrate about 79 natural gas plants. It's operationally complex, and we assume management will be able to synergize. But overall, we rated a buy.
Go back to slide.
Sure.
What is your assumption around AI CapEx slowing
So
for the bear case? Like you say, hyperscaler CapEx slows. What do you say it slows to?
So we don't. For us, we're mostly forecasting energy demand for the next few years. But overall, I mean, basically they're saying nothing from all these big tech companies. They say it's not going to slow at all. All they see is complete uprates, re-rates upward.
Sure.
So really slowing, we just assume, a slower growth rate. It's not like we directly put it into our valuation.
There could be supply chain issues or government regulation among the chips that they're allowed to use that might slow data center demand. It's things like that might slow down the actual build out of the AI infrastructure within the U.S., and that's what we identified as slowing capital expenditure from the hyperscalers.
Can you go back to the slide that has the Microsoft and Meta website? So I take it that's the same place to print each one. I don't know where it is, but it's the same place.
So the Microsoft deal, they're actually reopening the Crane Clean Energy Center. So it was a nuclear plant that was offline. They're reopening it for the sole purpose of this purchasing power agreement with Microsoft. Meta is actually a different area. They're going to be generating from an Illinois plant that they have. And that Illinois plant, they're currently undergoing upgrades to increase the generation capacity. And it's actually they're going to go from about $34 per megawatt right there to $115 once Meta takes over in 2027. So that's one of the main drivers of revenue for them.
So these were closed facilities, or this was?
The Illinois one was currently operating. The Crane Clean Energy Center was closed. They're reopening it for Microsoft specifically.
Who are they? I guess they were selling energy at the Meta one already, right?
Yeah, they're already selling it.
Yeah.
Yeah.
They have contracts with other maybe local ISO markets or wherever their energy market is, and those are at much lower rates that don't reflect current market rates. They're at about $34, which their levelized cost to generate nuclear is at $34. So they're not seeing much profit out of that. So once that is able to drop in the bucket of $115 per megawatt hour, that's a substantial difference.
So they're growing by the Calpine acquisition. Is there much else they can do with their own facilities to, create incremental supply?
Yeah.
Over
Yeah, the CEO, Joseph Dominguez, he says wherever we feel like we need to spend capital to upgrade and free up slack within our capacity, we'll be able to do that. And they have the balance sheet to be able to support that investment. And they're only going to do it, and management only hinted towards doing it if the demand is there on the other side. So they have the ability to free up slack in their system, and they're only going to do that if the demand is there on the other side of it for them to contract it.
How do you build a nuclear power plant very quickly? Well,
You don't.
what slack? That's, I guess, my question.
I guess it's just more facility efficiencies. I would say something just here and there. That's more getting into the nitty gritty and the nuclear science of it. Well, I know to build a nuclear plant, you could look at the Vogtle and the Southern Company build outs, which in the 2010s was just a complete failure, and I think took more than a decade of time to build, and cost overruns which were excessively high, which is why we feel like Constellation's nuclear fleet is better, because nobody is building new nuclear.
What are the key risks with this company?
I would say that a lot of the revenue assumptions foresees an elevated price environment, which right now, if you ask any of the big tech companies, they say right now the biggest constraint is not in the hardware or the software, it's in power constraint. It's the constraint of the power and all the regulatory hurdles you need to kind of jump through to build out that power. So the biggest thing is if the electricity demand doesn't materialize, and if this AI infrastructure build out doesn't keep going, because that is really is big one of our thesis points along with the elevated price environment. So it's just if electrification and grid investment doesn't continue.
They don't own the grids between the plants and the AI centers, do they? That's
Like transmission lines.
Yeah.
No, they don't own any of the transmission lines. They just generate, and then they sell into the ISOs, the integrated system operators, and the RTOs. So yeah, they sell to them directly. Yeah. And sometimes they also directly have C&I, so commercial and industrial customers, which I guess might fall into the bucket of a Microsoft and Meta, where they contract directly. Like they, in their description of the company, they supply power to 3/4 of the Fortune 100. So they probably directly supply to those facilities, contract with them somewhere.
3/4?
Yes. Yeah. So they position themselves to be the best in class provider of electricity in the current market.
Was your debt to equity, did that include the Calpine debt that they took on to do the acquisition?
Yes, it does. It was based on Bloomberg estimates and analyst estimates.
And they also inherited some market debt in the form of bonds from Calpine. It was only around 3 or 4, so it didn't significantly impact the market value of debt, but it was included in the WACC calculation.
what is the current PE ratio, and how do you expect earnings to grow over the next 3 years?
So the current PD ratio was, 35 times.
Okay.
And that's the trailing 12 months, so that's not really the forward estimates. But I would say that we expect earnings to materialize if they're able to lock into another power purchase agreement.
And Calpine is also immediately accretive. They're contributing around $3.7 billion annually in EBITDA, which is why it's such a big deal. It's a diversified asset base for them, and it gives them more generating assets, which will just drive bottom line. But it also is able to make direct contributions to the free cash flow to the firm, and their ability to invest back in themselves, and their ability to make returns for shareholders. So,
Are they pursuing other PPAs?
No, given the size of Calpine, I don't feel like they are. It's just mostly, I think, capital investment.
they built a very
themselves.
defensible position with their moat around nuclear, and now adding natural gas generation only strengthens it.
So what's the earnings growth rate for the next 2 or 3 years? 10%, 20%?
So there's a jump in the next year because of Calpine.
The immediate accretion.
Sorry, guys, that's,
No, I can keep going.